The problem is the bubble this time is not the commodity markets. It's not gold. Gold's only doubled over the last 5, 6 years, 7 years.
Gold's still up on the year, but it is falling quite a bit. Silver is falling quite a bit. It's under $21. The stock market is selling off. What do you make of what's happening in the markets today?
It's pretty clear, but it's still, we're at a point now that's pivotal. Let me explain why. First off, stock market. Stock market is a bubble. It's the biggest bubble in U.S. stock market history on a percentage basis and on time duration spent on the upside from 2009 low to late last year, okay? Parabolic blow-off market. Sponsored by the Federal Reserve's QEs and monetary growth. So we had inflation. You don't like inflation? Well, that was it. The stock market can be inflated too, okay? But that's okay. They accept that. Okay. Now, so they want to come in and fight inflation. But the problem is that this is not 1980 when gold had just gone up 8-fold in price and topped. And that was coincident with Volcker raising rates, which had already been underway prior to him becoming head of the Fed in 1979. But gold had an eight-fold gain. Commodities had a doubling over a 3-year period. Stock market was dead flat during that time. So at that time, people like to look back and, the Fed broke inflation. Okay. Yes, but those markets had a massive multi-year move. Gold had an 8-fold move. And the stock market was dead. So the bubble back then, if you wanted to call it that, was gold. And therefore, it doesn't shock us as a technician that gold peaked back in 1980, and stocks later in 1982 finally woke up and started a bull trend. Now we have a similar situation where people think, Powell's doing a Volcker. He's going to raise rates to stop inflation. The problem is the bubble this time is not the commodity markets. It's not gold. Gold's only doubled over the last 5, 6 years, 7 years, not 8-folded. Commodities have only recently, in the last year or so, turned up. So they're a fresh annual momentum uptrend. And they're clearly not back to their 2011 highs. People don't realize that. You look at the Bloomberg Commodity Index, it's trading in the 120s. Well, it was a lot higher than that in 2011. So yes, it's up. Yes, it's gaining strength. Yes, there's, quote, commodity inflation, but it's nowhere comparable to the 2011 levels. Okay. What is the bubble this time around is the stock market and certain other related asset categories. Other markets that have gone up along the stock market are muni bonds, high yield corporate debt, and treasury bonds. Treasury bonds, as everybody's seen the charts that technicians have put out, a 30-year uptrend in price, drop in yields. Massively aged. It's broken. Okay. So if you're a portfolio manager and you're looking down at your grid of your portfolio components, you've got the stock market. Well, okay, so far this year to date, let's do it. The S&P is down, I just calculated a few minutes ago, 18% on the year. Okay. NASDAQ 100, the leader index, is down 28% on the year. TLT, which is an ETF for long-term government bonds, 20-year plus duration, is down 20% on the year. Okay. Again, these are asset categories that people like to get into. Okay. High yield corporate debt, down 13% on the year. Muni bonds, down 10% on the year. Okay, what's left? Gold is unchanged on the year. So yes, gold has had a punishing sell-off, somewhat incoincident with the stock market, but it's the only asset category at this moment that is actually up on the year of the major normal, what you call asset categories. Gold being the one that most asset managers would deem to be the alternative. Okay, well, it's performing like an alternative. Okay, now, it's recently been in sync with the stock market. And I say recently, I mean only since about mid-March. Prior to that, it was moving somewhat opposite to the S&P if you look at it even on a daily basis. Okay, now it's somewhat in sync with the stock market. So the question now is, okay, is the stock market going to do another October 2008, where you had a 35% crash late in the bear market, or a March 2020, where you had a 35% drop in a matter of 3 weeks in the S&P, and gold joined coincidentally with that over a 6-day period late in that break. Is gold going to join in with further decline in the stock market? Okay, then the issue becomes, okay, well, is the stock market going to do a crash number on us here? Or is potentially at a level where it might actually hold for a while, and it could generate a bear market rally, a genuine bear market rally. Okay, Momentum Structural Analysis declared a major top in the NASDAQ 100 as of the January close of this year. It wasn't very far off the price highs of December at that point. And the February close in the S&P generated an annual momentum long-term trend sell signal in the S&P for us. Shortly after issuing those sell signals, the market dropped into March, then had some bounce. It's now approaching a number on both indexes that we had specified several months ago as a possible point where in the decline, the bear market trend that's now begun, we might actually get a period of pause and a rally, not just a 1 week rally, but maybe even hold on it for a month or two. That number was 3,800 for the S&P, and today we traded into the 3,800s, okay? For the NASDAQ 100, the number was 11,500 something for this month. It got down to 11,600 today. So both of them got within very close proximity to certain levels that we previously specified as a possible point to stop this particular sell-off, so it doesn't become a crash situation. Okay, so therefore, what we're doing right now, as far as gold is concerned, we're watching the S&P. Because since gold is now in sync with the S&P, if the S&P breaks those numbers significantly, if NASDAQ breaks our numbers significantly and indicates, no, it's not going to hold where you thought it might, temporarily even, then gold might participate further on the downside. In which case, we could get a replica of that March 2020 event or that October 2008 event. Now, those, by the way, and we've gone back through the history. In fact, I've lived a lot of the history of gold. Of the three crash type events like that, where you drop more than 35% in the S&P in a matter of several weeks, that'd be October 2008, March 2020. There was one other, and it was obviously October 1987. It was a crash that I happened to personally catch. At that time, in the 87 crash, gold exploded. Remember that. Okay, it doesn't always crash with the stock market. The last two events are spread a dozen years apart, 2020, 2008, so not many examples of this. So I'll give it the opportunity, if the stock market doesn't hold our support level and drops sharply, and it better do it quickly because otherwise it's not going to do it, then gold might participate. But if you go back to those last two events and study them carefully, the 2008 low in October 2008 and the low in March of 2020. When gold did its tantrum in sympathy with the stock market, it exploded after that. You couldn't buy a pullback. It just rocketed out of the hole. Such that in 2008, for example, the stock market had the crash in October, but it didn't finish really going down until March of the next year. By February the next year, gold was back to the highs. By February of 2009. So it divorced the stock market once that tantrum occurred. Okay, look at March of 2020. The S&P made a crash low then. Gold made a somewhat crash-like low. It wasn't nearly of the dimensions of the S&P drop. Within 7 days, gold was back to its high. It took the S&P 5 months to get back to its prior high. Gold rocketed back in 7 trading days. So if we do get an event like that, in this particular decline in the stock market, and it drags gold with it, it's a buying opportunity. The question is, are we really going to get that kind of tantrum event where, the word is sell everything? And I don't know. I do know where we need to hold on the stock market, and we're approaching that level now. And frankly, my suspicion is you're going to hold it, in which case gold is going to hold as well. And again, right now, when I look at the tape, gold is up $5, $6 on the year. No other asset in the world is up on the year. Okay. So anyway, that's the context we're looking at right now. Does gold follow a further stock market decline, or is the stock market about ready to put down its foot and say, okay, now that everybody's bearish, that seems to be the sentiment out there, I'm going to have a rally? I don't know the answer, but I know we're in the zone now where the decision is going to be made.